All right, so we're talking Robinhood and options contracts. So, why options? Well, options are awesome because they allow you to short, and it's a way of shorting a stock on Robinhood. Because as you know, if you've been trading on Robinhood, you cannot short stocks, at least not yet. And it's a in my opinion, it's a lot easier to call out when a stock is going to drop compared to when it's going to rise. Why? Because in order for a stock's value or price to go up, there has to be significant volume. There has to be enough people and money that steps into the market, and everything in sync has to like line up with the buying, the right amount of people. There has to be more buying than selling. Short sellers have to be squeezed. Like, in order for the price to really pump and push up significantly and for you to make money on the upside, it takes a lot of putting the right pieces together and seeing that volume building up and everything before you actually get that push. And a lot of times you don't get the full push, and you actually get a squeeze to the downside, and the bears win. And it's a lot trickier, in my opinion, calling something going to the upside. Now, if you're a swing trader and that's just part of your strategy, that's fine because you're already buying at a low and you probably have a tight stop loss and all that stuff. But in my opinion, I like shorting the market as much as I can because I think it's easier. Why? Well, once there has been a push and all those stars have aligned and the volume is pushed up and price has gone up to a certain level, you can start to see when price kind of just gets to the point where it caps out and it starts to just go sideways a little. And that's usually a good sign that there's going to be some sort of pullback. Why? Because people take profit. Institutions take profit with any 3% move, 5% move. So it's important to realize that price moves in waves. I mean, this is a known thing. This is nothing new. And hence why I like to make money on the downside and maybe pick shares back up if it's truly a stock or a company I believe in. But essentially, I'm going to show you guys today a small contract that I purchased this last week. I bought it on Monday. It was a put, which is essentially you saying that you think the market's going to go down. That's the opposite of buying a call. A call is like going long. A put is going short. For those of you who just don't know how options work, please do your research on all the technical stuff of options trading. But essentially what happens with options is you are buying 100 shares, per contract. You can buy several contracts, but for every contract you buy, you're essentially buying 100 shares of the company without putting up the money for 100 shares. And so the way this works is when you want to buy a call or buy a put, you're essentially saying that you think by a certain date the price will be above or lower than a certain price. So if that's a little confusing, this is what I mean. So let's say Apple stock is at, let's just throw it out, $300. Apple stock's at $300. Or let's say ABC stock is at $300. So today's Monday the 1st. And let's say Friday, this upcoming Friday, that'd be 4 days, the 5th or the 6th. Friday, you think that the price of ABC stock is going to be under $300 because, you could have your reasons. But like, for example, I would be like, the stock recently ran from 280 up to 300. I expect a pullback. It's an all-time high. I expect some sort of pullback. So if today is Monday, it's at 300 and it's already starting to trade sideways. I'm seeing volume disappear. Well, I can pretty much bet that by this Friday, just 4 days from now, especially if it's a slow moving stock, it'll have some sort of pullback and it won't be too far away to where the price will go down but then go back up on you before the option expires, although that doesn't matter because you can sell it early. You want to kind of just estimate, you want to have a good time frame for how the stock moves and where you expect it to be, and I'll show you what I mean in a sec. And so you want to, if you think that in 4 days from now, when the contract expires, you think it's going to be even just 3 pennies higher than 300, then you're good because you'll be in the money or whatever the break-even price is, which it'll tell you on the app. And if you expect it to go down, then you would buy a call, and you would let it do its thing. And so the cool thing about this is you cannot lose. There's no infinite amount you can lose. It is essentially when you short a stock, like actually short it, you borrow shares to repay them later. There's a technical truth that in theory the stock could go up forever, infinitely, right? Of course that doesn't happen, but just in theory. So you can infinitely lose money, especially if you get caught holding a bag that no one's gonna buy. And so essentially what happens is that's an undesirable situation if you're a newbie. But with contracts, the max you'll lose is the contract amount that you bought the contract for. That's the amount you'll lose. And I'll show you what I mean right now. Okay, so we're on Robinhood, and my favorite stock this isn't a stock, this is a ETF, but my favorite stocks and ETFs, mutual funds, whatever I like to mess with is with like index funds, things that are they have movement, but they're not volatile to the point where, or they're not non-volatile to the point where you get no action. So, for example, this past Monday, let me show you. This past Monday was the 4th, March 4th, right? Yes, because you can see March 1st jumps to March. Okay, this is Monday. This is this past Monday, March 4th. Close this. On March 4th, you can see here, March 4th, I bought a put meaning I think it's going to stay or go down. A put for $275.50, and the expiration date was March 8th. So literally 4 days later from March 4th. I purchased it on Monday, saying that I think by Friday, 4 days from now, it's going to be less. It's going to be at or less than the $275.50 that it was roughly trading at the time. I think it was a little higher at the time. So right here on March 4th, just pretend that anything to the right of the mouse right here of this line is not there at the time. This is what I'm seeing. So on Monday, I'm seeing this. This is all I see is this part of the graph here. I can see that price has pushed up, had a small retracement, tried pushing up again, got higher but not too high, had a retracement. This time it pushed, but it didn't really. I mean, it went higher, but I wouldn't say it went much higher. 278.41, 270. It didn't. Just by the look of it, you can see that it doesn't go much higher, and it's just getting to a point where it's kind of like it's getting harder for it to make new highs. And so eventually, I see this last push up to March 1st. This is a Friday. On this Friday, I'm looking at it and I'm saying, okay, this is starting to look like it's a good pullback zone. I can see that the momentum is starting to slow down. Volume is slowing down. And so on this day, it's like, okay, I'm looking to get in on Monday. If it doesn't break a new high on Monday, I'm looking to get in. So sure enough, on Monday, it opens up like around the mid range, and then it starts to crash. So I open up, I bought that put. I bought the put to stay at $275.50. I had got it, let's see, I'm going to say I had got it maybe around 276 or something. I'm not too sure, but I was a little bit higher than the 275.50. And I essentially went with my gut feeling that within the next few days, price would go down. And sure enough, that's what happened. So you can see here at my trade, my history, I bought the put March 4th. For $60, one contract, right? One contract. So that means that the maximum I could lose on this is $60. So for example, let's say Tuesday, Wednesday, Thursday went by, and the price is even higher, and I haven't sold out. By Friday, if the price doesn't magically come down to my break even or lower, my contract's just gonna expire worthless, and I lose $60. Okay, fair enough. But the good thing is that when it goes in your direction, it can go essentially to zero, and if it does, you're gonna make a lot of money. Like if this would have crashed to zero, I would have made like $24,000 off 60. That's insane. That's not gonna happen. So you can see here that I got filled on March 4th at 2:54 p.m. for one contract at 60 cents. So this means that from the 60 cents, any movement in my favor, that's what I'm making, right? So you can see that I had got filled at 60 cents. By March 7th, 3 days later, this is Thursday, and I know what you're going to say. I could have made a lot more money if I would have waited for my contract to expire. Whatever. 60 cents. I closed out at $1.40. That means that the price had moved $1.40 in my favor. And that's how they determine how much you make, because remember, you get paid per contract. So I had got in at 60 cents. It moved to $1.40. It didn't move $1.40 after it moved to $1.40, which is 80 cents. So that's why I made an $80 profit. There was a 60 that I had bought in with, plus the 80 is 140 total. That's why when I sold just 3 days later on March 7th, I closed out for 140, which is a profit of like 100 and something percent, 120%, I don't know, 130%. And so, as you can see, this is the power of being able to trade contracts on Robinhood, where there's no fees. There's no $10 to open, $10 to close, taking out $20, bringing my profit down. And there's a cap on your risk. And as long as you can learn how to gauge these movements, you can do really well with options. See, like here you can see 274.38. This bottomed out at 274.46. I would say that from here the market could go up. On Monday, if you're able to get a call, well, let's see. Let's go back a little further. Yeah, you could say that this might continue. I mean, this might just be the beginning of the downturn, of the bigger pullback, or it might just continue back to the upside. I don't know. Because this is too big. See, when it's this far in this big of a picture, it gets a little more difficult to call. So there is definitely a lot of room for it to go, but that was a significant pullback. And this is what I mean by I could have made a lot more money. When I closed out on Thursday the 7th. Thursday the 7th was here. I closed out around, I think if I remember right, it was around here, 275.20, 275.20, 275.25, that area. I closed around here. The thing is that my option expired on the 8th, this day. And look how much lower it came, 272. So I closed at 275.20, and I still made 130% profit. But I could have closed, remember, that was a 80-cent movement pass. So that means that I had bought in roughly like at 276, like I said. I bought the call. And so it moved 80 cents in my favor. Now, had I let it run to 272, had I let it run to 272.54 and closed out, let it expire or close out here on this day, oh my God, think about it. I would have made around $400, like $350 to $400 in profit off of $60. That's insane. Now, I've been trading for 2 years now. I have a decent understanding of how price moves and how it flows. I would really recommend you guys work on this and find ways to understand how it moves so that you can take advantage of these swings, because they're really not that hard to call if you're just a patient person. I do not place a trade unless I feel really good about it and I've been waiting for it. Like this trade, I had been waiting for it. I have been waiting weeks, like a good week and a half before I pulled the trigger, because I was waiting from over here from February 11th. Well, no, I didn't wait for here. Once it was like in this area, I was looking for the turnaround. I could see it wasn't pushing much higher in this area, but it took from the 21st, 22nd, all the way to the 4th for me to, that's a week and a half. Like it took that much time for me to be like, okay, I'm going to do it now. I didn't just see it and I'm like, okay, tomorrow or the next day I'm going to do it. That's too close. You want to be able to really grasp the full swings of prices. And if you do that, I think it'll help. I'm going to continue posting my Robinhood trades. I don't like to post them before because I don't want people just copying my trade. They're going to blame me. They're never going to learn how to truly trade like that. So I'm going to always post them after. But I mean, I'm going to have proof that I bought and sold. I'm going to have my history. I'll show everything. I have nothing to hide. I'll even show you guys my account so that you guys know this is the amount I have right now. This is how I've grown it over time. It's going really slow right now. Okay, so this is the weekly. You can see I was hovering around 4,130. I was able to get it up. My stocks would pull back. And I was waiting for them to take off. Once they finally took off, boom, I got to now this level. So now this is my new low. I do not expect to go lower than this. This is my monthly. A month ago, I was trading at around just 4,000. And look how I'm not looking for big jumps. I always look for realistic $100 every few months. At one point here, I was trading at 2.7. I had a big pullback right here. I think this is when I was holding. What was I holding? Was I holding pot stocks? I forgot what I was holding. I was holding something that, well, the whole market in December crashed. So that's why I'm sure 90% of any trader's account looks like this, because I'm going to say 98%. The market crashed. That was normal. But of course, it rallied, and that's what allowed me to come back up. Why? Because I was patient enough to hold. This is my yearly, so overall, I am up. This is wrong. See, I don't understand how this works. My account did not start with $3,650. Like, my account started with $1,000. So I don't understand how this works. Let me see what happens if I do alt. Okay. Oh, okay. So it just doesn't go back because, yeah, 4,540. That, what? Like, dude, I opened my account like 3 years ago. So I'm assuming this doesn't just go back that. I don't understand why. I don't know. I'm so confused. I'm really confused.